Hi, I'm Peter Rose, founder of Longwood Currency Trading. More thoughts on taking that last trade of the day. I did a video not long ago. If I remember, I'll throw the title and the link down in the show notes. We talked about the last run on the ski slopes. If any of you ski, you sit there and say, oh, I'll just take one more run for the day. And that usually ends up being, you get hurt. And it seems that when you're trading a lot on a daily basis, that last trade that you take seems to be bad. So, you can look at that as doctrine. Don't make the last trade of the day. Or you can look at it as something went wrong in your brain through the process of your trading to get to the point where you thought you were omnipotent and could take that next position, that next trade. I think the issue is if you're trading multiple times a day, you only really do your analysis upfront one time. And I think that's valid. But that goes with a caveat. My course, the fast track course that I have, is a day trading course based on, well, everybody works, right? And so it's based on getting your trading done in an hour or 2 hours a day. So you can't expect to get 40 pips in an hour. You might if you catch an NFP the right way, or you're really experienced and you go in and do 40 pips in an hour. I've done 40 pips in an hour, but it hasn't been by plan. It's been by circumstance. So you have to have a plan, a general plan. And if you're going to plan to trade for an hour or 2 hours, and you're fortunate enough to sit down at the trading desk just at the right time that your analysis says, hey, there's something to do right here in the next few minutes, and that comes out, the volatility is there, and you get your 8 pips or 12 pips or whatever it is that you are targeting on a daily basis, and you shut down things and head out to work maybe. Or you're taking a shorter term view. Maybe the market isn't there for a 12 pip straight run. Maybe you're in a well, you're not going to trade a chop, but you might be in a range bound period. That range might be the previous day, or it might be the previous 2 hours, or something like that. But you're seeing that price is reacting quite clearly to structural congestion areas from order flow. And so you may be in and out trading for 2 pips or 3 pips at a time. You're scalping, obviously. When you scalp, you still need to do an overall analysis, entry analysis. That I teach in the fast track course, the life cycle of a currency position, entry analysis, position management, exit methodology. And so you're at least getting that entry analysis down. There's a certain way that you manage that position management section of the life cycle of a currency position, because you're not in the position long enough to get to position management. You're still in the entry analysis phase. So mentally, you have to be doing this stuff in real time. So if your rules aren't really good, if your entry analysis rules aren't really very good, that you can rinse and repeat and rinse and repeat and rinse and repeat on entry analysis and not worry about the position management, because that phase just isn't going to be there. The life cycle coalesces between something that you can get, entry analysis, position management, and exit methodology out, and maybe that trade is going to run 15 minutes for you in order to run that life cycle through and get your 8 or 12 or whatever number of pips your average number is for the day. You have to take that life cycle and you have to condense that down into, 2-minute segments. Because if you're taking multiple trades, you're going in and scalping. So you're not staying there long. You're riding that range-bound movement, which can be chaotic on a short-term time frame. So you have to back out and you have to look at where these ranges are, and then you have to be down on a very short time frame so that you can see the pending preponderance of evidence leading to a reduction in a particular direction that price happens to be in at that time. There's a lot of juggling going on with your thought process and your rules, and that's why you really need to keep your rules simple. I think that the problem with most folks is they don't have a logical structure to their trading rules, right? That there's no boundary conditions between the entry analysis, position management, exit methodology. I mean, you're all doing that whether you know it or not. I'm just breaking them out as separate phases of the life cycle of a currency position, and I'm writing a rule for it. And that rule contains 2 to 4 conditions. So it's very simple. The complexity on that comes, even for people that are aware of that, is that when you get down into trading range-bound price action, you don't have the luxury of sitting there and building a position into where you move from entry analysis into position management, or where price action takes you from entry analysis into position management, because those things are, the boundary conditions on those are not there. They're not digital. They become analog. So you're thinking in a digital response from a rule, from a condition series, going through a series of conditions. Condition A is okay, condition B is okay, condition C is okay. Okay, so that boom, that gives me a binary result. But you're evaluating those binary results in an analog manner. That's why you need a mentor for this kind of stuff. And I spend a lot of time talking with a student who takes the fast track course, because that's what it is. It's mentoring. Just giving you a manual or a PDF file isn't going to do you any good at all. You might as well just read a book. You know, read Reminiscences of a Stock Operator by LaFerre, and you know, you should be okay. But you're not, because you need somebody to answer questions in real time, whether that's during a study period or whether that's you're doing trading in live term trading. We're talking and you're doing live term trading, and you're asking, what would I do at this particular time, or what do you think? I'm thinking of taking this trade, and we could communicate and say, well, what does your rule say? Well, what is the price action telling you that it's doing? What's the order flow condition at this particular time? What's the time of day? Where's the what was the opening time and of the market you're in? And where is the condition coalescing of the activity matching, trading activity, where both pairs are most active during a period? Because you can have periods where one of the currencies of the pair is active, but the other one, they're going home for the day. They're still trading because it's a worldwide trading, but you're going from these centers of action. If you're trading Swiss franc and yen, then you're looking at the Swiss franc being really active at this particular time, and then the yen catches in there, and you're trading that at that time, and then gradually the Swiss franc will go off the scale, or the yen will go off the scale, and it won't be as active. So the range-bound motion that you were trading, that you were depending on, is going to have different fluctuations depending on where that bubble of major activity is going. It's pretty complex, and that's why you really need to ferret out what are the possibilities for order flow and price action matching up. What kind of structures do they present? Some people would call those patterns. But a pattern, the problem with looking at patterns is you're looking for the pattern. what I look for is process. What's the process of the blending between price action and order flow at that particular time? I'm looking for the process of the price action, and that's very similar to a pattern, but it's not a pattern. You'd have to sit down and talk about it. Trust me, it's a lot easier to do it that way than it is to go, oh, this is a flag pattern, and so I should do this, that, and the other thing, or here I've got an engulfing candle pattern, or a shooting star, or some fucking thing, and this is too much information to be jiggling around in your head, particularly when you're day trading and you're trading in a 2-hour period. You've got a range-bound action, and you slip from day trading into more of a scalping mode, where you're going to end up for the day maybe making 5 trades or 6 trades during that 2-hour period of time that you have before you head off to work. As a day trader, I teach 1 trade a day. That way, in 2 weeks, we've got 10 trades. You can do metrics based on that. Everything is great. But if you're doing 3 trades a day, which is fine, you're just condensing the metrics down into the mathematics of it, and that makes it difficult for most people. I like to do it in terms of days. So if it takes you 10 days to do something under the conditions of a structured life cycle of a currency position and the trading plan, and you get good at that, such that you do 10 trades in 2 days, then you're condensing all that stuff down. You can't think in terms of days. You have to be really skilled so that you can map all that stuff into a very condensed period of time, right? So that taking the last trade of the day loses significance the more trades that you're taking during the day. So I think that folks that are running into the mindset that you got to be very careful of the last trade of the day is they're only making maybe 2 trades a day on average. And so the time that they're going to take that third one, they usually get hurt because well, there's only so much capability that we have if we have to go off to work or if we've got something to do, and we only have an hour or 2 hours to trade in the morning. You know, it may take you an hour sitting there waiting for those conditions to hit to give you the entry signal. That leaves you an hour to be there. So if you've had to wait an hour to have things put together, you're generally not going to see the conclusion of your trade in 15 minutes or 10 minutes or 40 seconds, because you're in that range-bound motion, which is a little more slow-moving than your, if you were in, I hesitate to say trend because there's trends at all levels. So when we talk in terms of trends, we talk in terms of, this is a trend for today or in the next 4 hours. That's very rare. Those types of things only happen about 30% of the time. So you have to be skilled in not worrying about the last trade of the day, not worrying about the first trade of the day, but worrying about the process of trading itself, so that you're not worrying about things that don't need to be worried about unless the conditions of your rules go, boom, hey, this is happening. It's very important. Most of you that I talk with, either through email or that broaches into a video conference, I try to get as many people as possible to get on a video conference because we could say a hell of a lot more in a video conference and make sense than we can typing back and forth in emails. But in discussing this limited amount of time as day traders that we have because of our job situation, or maybe it's family or whatever it is, but you've only got 2 hours. If you have less than 2 hours, you better be pretty experienced to be able to swing into the room, look at the chart. Okay, nothing right now. Go back out, come back in 15 minutes. Yep, things are ready to go right now. Boom, you hit it, and you take your 3 pips and you get out, and that's good. 3 pips a day, 4 pips a day, 5, they all add up. They all add up. You've got 200 trading days a year. Don't try to make 40 pips in a day. You've got time to do that. If you could do 40 pips a day, God, you'd be totally broke. You'd be wiped out. Because the more pips you try to get on a daily basis, the higher your risk of ruin comes up. And then you're pushing it and you're pushing it. And maybe you're trading a little higher leverage than you should be, or you're taking more risk. And, oh, I'm looking at the Bollinger Band and this is what happens. And I'm going to push all my chips to the center of the table. And whoops, I got that wrong. And you're 4% down for the day before you know it. It's really hard to get 4% down for the day when you're making multiple trades during that trading period, because you're not thinking in terms of greed. You're only thinking in terms of probability and opportunity. So I'm not saying that scalping is better than the day trading. I'm saying that there's a place for the scalping to take place. I teach day trading because that's the core. You're presented with enough information and enough opportunity in a 2-hour period of time that you can learn everything you need to learn about currency trading. And then when the ranges get really, really tight and you go into that kind of thing and you want to scalp, you have the skills to scalp. But if you're a scalper, you can't come in and day trade or position trade. If you're a position trader, you can't drop down and day trade. It scares the crap out of you because you don't have the skills to do that. But a day trader will have the skills to move up and take a position trade. I do that all the time. I'll be in there trading. Maybe I'll make 2 or 3 trades during the time that I'm working on, and that last trade I get stuck with it, and I go, well, but I have a strong feeling it's going to be okay. It goes between up 3 or 4 pips and down a couple of pips or whatever, but the analysis that I did indicated the probability is there for that thing to move. I did that last night. Yesterday, I was I'd done 3 trades, which the market was very active. And I booked, I don't know, I think it was 0.8% gain against my risk during that period. But I was in there for that 4th trade and I was stuck. I think it was the 4th trade, whatever it was. And it should go, it should go, it should go. And so I just, so okay, we'll just stop behind it and I'll just let it run. That was about, I guess, 2 o'clock in the afternoon. I had been there in and out on the trading desk quite a bit because it was snowing like this and I was in for the day. In any event, the trade carried over and I got up this morning and I got 1.2% against my risk because it went in the direction that I thought that it should. Now, it went much further than where I thought that it should go. There was a hyper reaction to it. And before I came in to do this video, that trade had run out another, the price action had gone out another, 40 minutes or so since I had originally went in and looked at it. And price had gone back basically to where it was before. So that's the situation that you're looking at. Don't worry about the last trade of the day. Look at the last trade of the day correctly in its correct structure, and I think you'll have a lot easier time in trading. And if you have any questions about this stuff, this is stuff that I cover in my Fast Track course. But if you have some questions about it, again, send me an email. I'd be happy to chat with you. If I can solve one of your problems right away by giving you a different way to look at something and you can go off, that's great, no charge. If you want to talk more in depth, we'll get on a video conference call and we'll try to do the same thing. And maybe it's just your process is screwed up. Maybe I can just help you think differently. That's what this video is about. Just think differently about things and you'll be a lot better off for it. But, there's always a but, you have to have good, solid rules, condition-based rules, sequentially condition-based rules in order to support that. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.